12 hours. That's all it took for nearly $300 billion to pour into one single metal. While most analysts were glued to stock tickers and earnings calls, something very different was unfolding thousands of miles away in Shanghai. An announcement was made on a major exchange, the kind of announcement modern commodity markets are not supposed to make. Zero delivery allocation. 20 account suspensions in 7 days. A widening premium between East and West that stretched into multi-dollar territory. And a 35% price recovery that ignored every conventional recovery pattern we've studied for decades. This isn't normal volatility. This isn't just another speculative spike. This is a signal. And the real question isn't why it happened. The real question is what happens next when the physical supply runs thin. Before we go deeper, if you value analysis that looks beyond headlines and connects the dots others ignore, take a second to subscribe. A lot of research and cross-checking goes into breaking this down in a way that actually matters for the next 12 months, not just the next 12 minutes. Now let's get into what really happened. On a Tuesday morning in late February, traders in New York logged into their terminals and saw silver up 7% overnight. At first glance, that doesn't shock seasoned commodity desks. Silver has always been more volatile than gold. But what made them pause was the scale and speed of capital inflow. In roughly half a day, estimates suggested that nearly $297 billion in market value had been added across global silver markets. That pace ranked among the fastest liquidity injections into a single commodity in modern trading history. Analysts immediately began pulling comparisons. In 2011, silver surged from around $26 to nearly $49 per ounce in a matter of months. In March 2020, during peak pandemic fear, silver spiked roughly 30% in days as central banks unleashed stimulus. But this February move was faster than both. Just days earlier, silver had dropped sharply to around $63.90 per ounce, triggering margin calls across leveraged positions. Overextended traders were liquidated. It looked like a classic flush, the kind of move that clears out weak hands before stabilizing. But instead of drifting sideways for weeks, silver rebounded about 35% of that loss in less than 7 days. Recovery curves that steep usually take months. Institutional desks started asking harder questions. Who was buying this aggressively? Why was the buying concentrated in certain regions? And why were the price signals so fragmented between continents? In Western markets, spot silver hovered around the mid-$80s range, with futures trading slightly below spot, a normal structure depending on storage and financing costs. But in Shanghai, the numbers told a different story. Converted into dollar terms, local pricing reflected a multi-dollar premium over Western quotes. In some sessions, the effective premium approached levels that arbitrage desks described as extreme. When the same commodity trades at materially different prices in major financial centers, one of two things is happening. Either logistics and transport costs have exploded, or one region is experiencing physical tightness. Shipping rates hadn't spiked dramatically. Insurance and customs flows were relatively stable. That narrowed the explanation to physical demand pressure in the East. Inventory reports started confirming what price charts were hinting at. COMEX registered silver inventories in New York were fluctuating but not collapsing outright, holding in the range of a few 100 million ounces available for delivery. On paper, that sounds substantial. But open interest on futures often represents claims on 800 million to well over 1 billion ounces depending on the day. Each contract represents 5,000 ounces. The leverage between paper claims and physical supply can run several multiples deep. As long as most traders settle in cash and roll contracts forward, the system functions. The moment a larger percentage asks for delivery, strain appears. Meanwhile, withdrawals from vaults connected to major Asian exchanges accelerated to levels not seen in years. Analysts tracking warehouse data noted that the drawdown pattern resembled prior periods of stress, particularly around 2016 and again during certain 2020 spikes. Physical bars were moving. This wasn't just algorithmic trading volume. Eastern buyers appeared to be accumulating tangible metal while Western markets remained heavily focused on derivatives and ETFs. Then came the regulatory response. Over the course of 1 week, the Shanghai Futures Exchange suspended 20 account groups for trading violations during the surge. In a typical month, suspensions might number 2 or 3. Concentrating 20 within 7 days is statistically unusual. Exchanges rarely escalate enforcement during calm conditions. When they do so amid rapid price movement, it often signals concerns about settlement risk, excessive leverage, or potential delivery strain. Market veterans immediately recalled the 2022 crisis at the London Metal Exchange, when nickel trading was suspended after extreme price swings threatened systemic losses tied to short positions. Exchanges step in when the clearing mechanism itself is under stress. The most striking announcement, however, was buried in formal regulatory language. Effective at the end of February, certain participants without approved hedging quotas would receive 0 lots of delivery allocation on silver contracts. 0. Not reduced. Not delayed. 0. Futures markets are built on a core promise. If you hold the contract to expiration and meet the requirements, physical delivery is possible. In practice, most contracts settle financially. But the credibility of the system depends on that physical backstop. Restricting delivery to selected participants under abnormal market conditions raises immediate questions. The phrase abnormal market conditions can cover volatility, speculation, or technical risk. But it also quietly acknowledges imbalance between paper claims and deliverable supply. Industrial users began to feel the impact. Solar manufacturers, electronics firms, and defense contractors all rely on silver's unique conductive and antimicrobial properties. The global solar sector alone consumes roughly 100 to 120 million ounces of silver annually, close to 10% of global mine production, which in recent years has hovered around 800 to 900 million ounces. When procurement teams report delivery times stretching from 2 weeks to 6 or more, that's not theoretical stress. That's operational risk. A mid-sized manufacturer using 80,000 ounces per month can't simply pause production because futures spreads widened. They need bars, not contracts. Now step back and look at the structure. For every ounce of physical silver sitting in a registered warehouse, there can be multiple ounces represented through futures, options, ETFs, and other derivative claims. This fractional structure is not inherently flawed. It provides liquidity and hedging efficiency. But it relies on confidence that only a small percentage will request physical settlement at the same time. If industrial demand collides with investment demand, and both tilt toward physical accumulation rather than cash settlement, the math shifts quickly. At the same time, global macro conditions are adding pressure. Government debt levels in major economies remain at or near peacetime highs. Central banks have spent years expanding balance sheets. Some sovereign institutions have been diversifying reserves, increasing allocations to tangible assets including gold and other strategic commodities. While gold dominates headlines, silver often follows in periods of monetary uncertainty because of its dual role as both industrial input and monetary metal. When sovereign entities accumulate physical commodities, they tend to hold them long-term. That metal effectively exits circulating supply. The East-West premium dynamic reflects more than simple arbitrage inefficiency. It reflects different market philosophies. Western financial systems are comfortable with derivatives and rolling exposure forward. Many Asian exchanges enforce stricter delivery frameworks on certain contracts, requiring more frequent physical settlement. If one side is content with paper exposure and the other demands bars, divergence can widen until either price converges or supply flows rebalance. History offers context. In 1971, when pressure mounted on U.S. gold reserves and foreign governments demanded physical settlement for dollars, the gold window was closed. In 2008, complex mortgage derivatives detached from the value of underlying assets, and when collateral calls intensified, the system cracked. In 2022, energy supply shocks in Europe revealed how quickly contract structures can fail when physical flow stops. Each case involved a gap between financial representation and physical reality. Silver may not trigger a global crisis on its own, but it can act as an early indicator. Analysts tracking other commodities have observed tightening inventories in copper and historically low exchange stocks in nickel at various points over the past few years. Lithium producers have increasingly favored long-term contracts at premiums to spot pricing, signaling buyer concern about future availability. These metals underpin electric vehicles, grid infrastructure, electronics, and defense systems. When multiple inputs show stress simultaneously, it suggests broader supply chain fragility. For business leaders outside manufacturing, the connection can seem distant. A software company may assume it has no commodity exposure. Yet cloud infrastructure depends on data centers, which depend on servers, which require silver, copper, and rare earth elements. Hardware delays ripple into service reliability. Rising input costs affect capital expenditure budgets. Banks become more cautious when real asset scarcity collides with high leverage. Credit tightens. Valuations adjust. What makes the current silver situation notable is not just the 35% rebound from a $63.90 low, or the near $300 billion surge in market value over a short window. It is the combination of rapid price recovery, widening geographic premiums, accelerated account suspensions, and explicit delivery restrictions within a compressed time frame. Each data point alone might be dismissed. Together, they form a pattern. That pattern suggests that physical demand in certain regions is testing the capacity of existing settlement systems. If the stress remains contained, prices may stabilize and premiums narrow as supply flows respond. If demand for physical continues to outpace deliverable inventory, exchanges may face increasing pressure to either allow higher prices to ration demand or expand restrictions to manage settlement risk. Neither outcome is trivial for industries reliant on steady supply. The broader lesson is about financial engineering limits. Derivatives can multiply exposure. Structured products can extend leverage. But no amount of contract layering creates new physical ounces.